Now, in today's class, we are going to discuss IAS 23 borrowing cost. In the last class, we talk about IAS 16 property, plant, and equipment. And when we are initially measuring property, plant, and equipment, we measure that at the cost, right? And in the cost, there were four things. First was purchase price. Second was directly attributable cost in bringing assets to its working condition. Third was present value of decommissioning cost, and fourth was borrowing cost as per IS 23. And I told you there that there is some kind of borrowing cost which you also have to capitalize while calculating the initial cost of an asset. So today we are going to talk about the borrowing cost. Now, what is borrowing cost? Borrowing costs are costs incurred by an organization on money borrowed to finance the qualifying asset. So basically, you have borrowed the money, let's say from a bank. Okay. And why did you borrow that money? Because you need to finance some asset that is known as qualifying asset. Now, what qualifying asset is, we are going to talk about that. But you have taken out the loan, or you have taken out the finance from the bank, or you have taken finance from the bank, and you have using that on qualifying asset. Now, cost on that finance, we say that it is a borrowing cost. Now, what is the cost on the loan? Interest cost, right? So we say that
Mm-hmm.
this is a borrowing cost. Now, the second question is that what is a qualifying asset? A qualifying asset is the one which necessarily takes a substantial period of time. Very important line, that a qualifying asset is the asset that takes some period of the time, substantial, which means a good significant of time to get ready for its intended use or sale. So a qualifying is asset is an asset which can take a significant amount of time, substantial period of the time to get ready, whether whether you are going to use it yourself, or whether or either you are going to sell that. Okay. So the asset which takes substantial period of the time to get ready, only that asset will be qualified, and that only that asset will be known as qualifying asset. And borrowing cost only deals with the qualifying asset. Okay. Now, what are few example of qualifying assets? Power plant, hydroelectric dam, bridges. These are all construction projects, and they are gonna take a substantial period of the time, right? You cannot get them ready in, let's say, 2 days, 5 days, 10 days, 15 days, 20 days, right? These are the construction projects that are gonna take substantial period of the time. So such an asset which is going to take a substantial period of the time to get ready, those assets are known as qualifying asset. Okay. So we are going to deal in the standard that how should we capitalize the borrowing cost, and the borrowing cost we will only capitalize on the qualifying asset. Okay. Clear what qualifying asset means?
Mm-hmm.
Now let's move on to the main part, the accounting treatment. How do you capitalize the cost? What is the accounting treatment? Let's understand that. Borrowing costs that are directly attributable to qualifying assets should be capitalized. All other borrowing costs are expense in the statement of profit or loss. Look, so far, the knowledge that you studied in the financial accounting, that interest cost is a profit and loss item, right? We haven't heard that, or you haven't heard that interest cost can also be capitalized, because interest cost treatment was very simple. That just put that, just expense it out in the statement of profit or loss. But now the interest cost on borrowing on the qualifying asset, you can capitalize that. Okay. And only that cost that is directly attributable to the qualifying asset, only you can capitalize that. Now, what do you mean by this? Let's say, for example, you are constructing some building, some plant, some dam, some bridges, and it qualifies as a qualifying asset. And let's say the construction period started from 1st January. Okay, the construction period started from 1st January, and it's going to end on, let's say, 30th October. Okay,
Mm-hmm.
30th October. Now, interest cost, let's say interest cost for the year, interest cost for the year was 120. Okay, interest cost for the year was 120, and you know that year end is 31st December, right? Now the question is, should you capitalize all of this 120 interest cost on this asset? No, you only capitalize the directly attributable. Now, what will be the directly attributable? You know that you
10
started the
months.
construction on 1st January. Exactly, yes. 10 months, okay? Till 30th October, 10 months. So you will do what? You will time a portion the interest cost. 120 is for 12 months. You will calculate for 10 months. That will be 100. Now, this $100, you are going to capitalize that. You are going to make that the part of cost of asset, and the remaining 20 you are going to put that into the statement of profit and loss. Clear?
Mm-hmm.
So only directly attributable costs are capitalized. Okay. Now there are two scenarios which relates to the financing qualifying assets. Okay, there are two scenarios which relates to financing qualifying asset. First is specific borrowing scenario. Second is general borrowing scenario. Now, specific borrowing scenario, you have got the funds specifically for that qualifying asset. Okay, let's say you are going to construct a dam, and you go to the bank and you took out the loan specifically just to use that on that qualifying asset. So such type of borrowings will be known as specific borrowings. Now how do we deal specific borrowings? Okay, how do we capitalize the cost? The cost capitalizes interest cost minus investment income. Now comes another confusion, that, well, we just talk about the borrowing cost, and we said that the interest cost we capitalize, but what is this investment income which we need to deduct? Now this investment income is the income that you have earned if funds were temporarily invested somewhere else. Now what do you mean by this? For example, let's say that you took out the loan of $1 million from the bank for constructing a dam, but the
Mm-hmm.
construction will start after 3 months. So you do what? Out of that 1 million, 40,000 you invested somewhere else. Okay, 40,000 you invested somewhere else. Okay, now if you have invested it somewhere else, obviously you are going to get some income, right? Now that income that you have temporarily invested somewhere else, and if it is directly attributable, you can deduct it from the interest cost and capitalize the net amount. This we do in the case of specific borrowings only. Now let's understand this with an example. Okay,
Mm-hmm.
let's do an example. Now, here is the example. Calculate the amount of interest to be capitalized in respect of the factory as at 31st December 20 exit. You have to tell that what amount of interest you should capitalize. Wilson receives an 18 million 5% loan on 1st January X8. So you got the loan on 1st January to finance the construction of the new factory. What was the amount of loan? 18 million, and interest cost was 5%. So 18 million, let me write it in the triple zeros form. 18,000 times 5%. The interest cost for the year is gonna be 900. Okay. So that is the interest cost. So you took out the loan of 18,000 on 1st January, and you are going to build a new factory. Well, it's a qualifying asset. As the funds were not all required immediately, Wilson invested 6 million in 2% bonds until 31st May 20 exit. Very important timeline, that you did not require the funds immediately. So out of this 18 million, 6 million, 6 million you invested somewhere else. And what return did you earn on that? 2%. What return did you earn on that? 2%. Okay. So this was your interest cost. So let me write interest cost here. And for investment income, how will I calculate that? 6 million means 6,000. And 2% is the return, because this is an investment, so percentage is return 0.02, and you invested until 31st May exit, which means January, February, March, April, May,
5 months.
5 months. So you will time a portion that with 5 by 12, because you invested that for just 5 months, so you are only going to get return for
Only
5.
that period. Mm-hmm.
Yes, so you will do. 5 by 12. So that is 50. Okay, so this is the investment income that you earned. Investment income is $50. Okay, clear?
Uh-huh.
And
Yes.
what was the investment duration from 1st January till 31st May? Okay.
Also 5 months.
Now, construction of the factory began on 1st March 20x8 and was completed on 31st December 20x8. So, the construction completed on 31st December but started on 1st March. Started on 1st March. So, what is the construction duration? From March till December, these are 10 months, right? 10 months is
Mm-hmm.
the construction duration. So it means that normally, not if let's say investment income was not there, we should have capitalized the interest cost of 10 months, right? So what is the interest cost of 10 months? 900 is for the year. So do that 10 by 12. 900 by 12 times 10. So that is 750. Okay. So if let's
Mm-hmm.
say the investment income would not have been there, simply 750 you would have capitalized that, right? 750 you would have capitalized that. But now you temporarily invested funds somewhere else, and we just talk about this, that if you are temporarily investing funds somewhere else, the investment income that you generate and which only corresponds with the construction period, you have to deduct that while calculating the cost capitalized. Okay. Now, 50 was the investment income. How much of that corresponds to the construction period? 1st January to 31st May was investment duration, right? And construction period started from 1st March. So it means that how much of the investment income corresponds with the duration, the construction duration? March, April, May. 3 months. 3 months of investment income corresponds with the construction period. So we are only going to deduct the income for those 3 months while calculating the capitalized cost. So 50 was the investment income for 5 months. We just calculated that. And out of
Mm-hmm.
that 3 months, which we have to deduct while calculating the cost capitalized. So this will give you 30, and the cost that you will capitalize is 720. This is the cost with in respect of interest or borrowing you are going to capitalize. Any question you want to ask, you can ask.
I understand. So we had
Okay.
only 3 months.
Now,
Mm-hmm.
what will go to the statement of profit or loss? Okay. What will go to the statement of profit or loss? The cost interest, how much interest cost was capitalized? 750. And what was the complete interest cost for the year? 900. So it means that the difference of 150, you will take that to the finance cost, right? Finance cost 150. It you will deduct this cost in the P&L because it is cost. Clear? Out of the
Yes.
900, 750 was included in the capitalization calculation. So it means the remaining
Mm-hmm.
150, or you can say the cost of 2 months, you are going to take that to the statement of profit or loss, right? You are going to expense that
Mm-hmm.
out. And the investment income, how much you are going to take there? $20. Why? Because out of the 50 that you have earned during this year, 30 you have included in the capitalization calculation. So the remaining 20,
Mm-hmm.
you will add that to the statement of profit or loss. Okay. Any
Yeah.
question you want to ask, you can ask.
Understand.
Okay.
Mm-hmm.
So now, if
Okay.
there are specific borrowings, which means that the funds are specifically borrowed for that qualifying asset, in that case, the cost capitalized is the interest cost that is directly attributable, okay, to qualifying asset. But if out of those specific borrowings, you use some of those to you use some of those and invest them somewhere else, and you get the income from that, then you have to deduct the income that corresponds with the construction period, or you can also say the directly attributable investment income while calculating the cost capitalized. The rest of the investment income will be added to the P&L, and the rest of the interest cost, except for the, the directly attributable one, will go also to the P&L. You will expense that out. Now comes second General borrowings. Now, general borrowing means taking funds from the general pool of an organization. You are not specifically going to the finance providers or the bank to get the loan for the qualifying asset, but the loan, the general pool, the general pool means the already available loan of an organization. You are going to take some amount from there. Then, okay. So, in the specific borrowings, you are specifically borrowing the loan, uh, specifically borrowing the loan for the qualifying asset, but in the general borrowings, you are just taking the funds from already available loan of an organization. Okay. In that case,
Mm-hmm.
how are you going to calculate capitalized cost? You have to calculate weighted average percentage and multiply that with the expenditure on qualifying asset. Whatever you need for qualifying asset, multiply the weighted average percentage with that to get the cost capitalized. Now, what how do we calculate the percentage? This is the formula. Interest payable on the borrowings, whatever the loan amount of the company, whatever the loans company have, okay, you are going to calculate the interest of them and divide them with the total amount of loan and multiply them with the 100 to get a percentage, and using that percentage you can calculate the cost capitalized. Now let's do that. There is an illustration in the book as well here. Now look, if an entity had a 10 million 6% loan and a 2 million 8% loan, the okay, so in this illustration he said that there's an entity who had a 10 million 6% loan and 2 million 8% loan. So now we have to calculate the weighted average cost. What was the formula? Interest payable on the borrowings. There are two loans. One loan is of 10 million, and on that company is paying how much interest? 6%. Another loan is of 2 million, and on that company is paying 8% interest. So this will give you the total interest cost that is payable on the loans, and divide them with the
Mm-hmm.
total amount of the loan, 10 plus 2 12 million, and multiply them with 100. So you are going to get the percentage, that is 6.33 percentage. They have already calculated that. Now you have to use this percentage to calculate the cost capitalized. Okay. Let's say, for example, the expenditure required for the qualifying asset is, let's say, 100,000. Now you are going to multiply this 100,000 with this interest rate that you calculated. Let's say the interest rate is 6%. So your cost capitalized would be 6,000. So this $6,000, you are going to add that to the cost of an asset. Okay. So in this way, you have to deal with the general borrowings. Very simple. Clear?
Mm-hmm. Okay.
Okay. Now, when do we start capitalization? When to start the capitalization? So capitalization commences upon all these conditions. When these three conditions are met, you have to start doing the capitalization. Expenditures for the asset being incurred, borrowing costs are being incurred, activity begins on building assets. So basically, you have started taking action for preparation or for construction or for production of qualifying asset. Okay, let's say you are purchasing the land where you are going to construct some building, let's say. Okay, you are going to take out the loan, and the start of the construction of the qualifying asset, you are starting that, you are doing the planning, you are doing the technical works that are required to do before the start of construction. So basically you have taken the action. Okay, when you have taken the action, then you have to start the capitalization. Okay, expenditures are started being incurred, borrowing costs are being incurred, activity begins on building asset. Borrowing costs are being incurred means that, let's say that you have started everything. Okay, you have started the construction, but you haven't taken out the loan yet. So let's say you have started the construction, but you took out the loan after 3 months. So when you took out the loan, only then the borrowing costs are being incurred, right? So you have to start from that period, the capitalization, right? So if all these three conditions are met, only then you will start the capitalization. Clear?
Mm-hmm.
Then, capitalization is suspended during extended periods in which active development is interrupted. Now, that is very important point, that you can also suspend the capitalization during extended periods. Extended period means, well, significant periods in which active development is interrupted, where the development of the qualifying asset, is interrupted. Why? Because of the reasons like bad weather, strikes due to the industrial dispute. Okay, let's say for example you started the capitalization in the start of the year, and mid of the year, because of severe weather issues, construction was stopped for 2 months. So you are not going to capitalize the interest cost related to that 2 months in the cost of asset. You are going to expense that out. Okay. Similarly, because of some industrial disputes, the employees are on strikes, for like let's say 1 month, 2 month, 3 months. Then during that period as well, you have to suspend the capitalization. Okay. Remember, you cannot suspend the capitalization if it is if there is a delay because of any kind of administrative work, or if the delay is necessary for the production. Like let's say you are preparing some big project. So after doing part of that project, you have to take a break, then you have to start. Okay. You have to take the break and then you have to start onwards. Like when you construct the building, you have to take the break for some time, and then you have to do the exterior works, right? Interior works. So if breaks are like that, then you cannot do the suspension. Suspension is only done when the development is interrupted due to the external factors. Okay. Like external factor means not related to, like, where the delays are necessary. Okay. Let's say if a delay is necessary, then during that period you cannot suspend the capitalization. But if the delay is because of like bad weather, strikes, then you can only suspend the capitalization. Clear?
Mm-hmm.
Capitalization ceases when substantially all activities necessary to prepare qualifying assets for its intended use or sale are complete. Now, when to stop? Cease means stop the capitalization when substantially all activities necessary to prepare qualifying asset for its intended use or sales are complete. Substantially means almost all of the things you have completed, you have done, which you need to do for preparing the qualifying asset to get it into the position. Okay, where if you are going to use that, or you are going to sell that. Okay, but it's ready. Now remember one point as well, that if there are some minor things, okay, if there are some minor things, then you are not going to consider that. Okay, let's say for example you construct a huge building, you construct a huge house, and you want to sell it to someone. Now in that house, you have completed all the stuff, like there's just a small minor interior rework that you need to do, interior design rework. Then you will not when the house is completed, you will say that the asset is activities, substantially all activities are completed, so capitalization is going to stop. You are not going to capitalize for let's say one more month, where just some minor works are left. Okay, got my point?
Yeah.
Okay. When construction is completed in parts and each part can be used independently, then stop capitalization on completed part. Now that is very important point, that let's say your construction is project is such that you have to do part completion. Okay, let's say you are preparing four buildings. Okay, you are preparing four buildings in an area. Now when one building will be completed, and you can use that one building separately. Okay, and the work on other buildings is in progress. Okay, that one building in which the construction is completed, and you can use that independent of the construction of other, then you will stop the capitalization on that completed building. Okay, but let's say if you have to sell the qualifying asset, and you can only sell the qualifying assets when all four buildings are ready, then in that case you have to stop the capitalization when the last building is completed. Okay, so if you are constructing in a part, and one part can be used independently or sell independently, regardless of the work in progress on other part, then stop the capitalization on that completed part. Okay, but if all of the parts
Mm-hmm.
needed to be completed, only then you can use the asset or you can sell the qualifying asset, then stop the capitalization when everything is completed. Got the point?
Mm-hmm. Yeah.
IS 23 doesn't applies on assets measured at fair value. You do not use the IS 23 borrowing cost principles on the asset that you measure at fair value. Like in the agriculture, we are going to talk about biological assets, and biological assets you measure them at their fair value less cost to sell. So you you cannot apply the borrowing cost in that scenario, okay, in the biological assets and inventories that are routinely manufactured on repetitive basis over short period of time. And inventories also, you can, you do not apply the borrowing cost on the inventories when the inventories, you are regularly manufacturing an inventory, and the inventory process is completed during a short period of the time, okay. So in that case you cannot apply the borrowing cost. How can it be applicable? Like, let's say you took out the loan for the manufacturing of inventory, so you cannot capitalize that loan, okay. But but if the inventory is such that it takes necessary or substantial period of the time to get ready for its intended use or sale, then you can capitalize it, okay, because then it comes under the IS 23 criteria, okay. But if inventory is such that is routinely manufactured on repetitive basis and just for the short period of the time, then you do not need to capitalize the borrowing cost. Clear?
Okay. Mm.
Okay. Now let's do another question and finish this standard. That's your understanding. 7. Calculate the total amount to be included at the cost in property, plant, and equipment in respect of development at 31st December 20x5. On 1st January X5, Sensco began to construct a supermarket which had an estimated useful life of 40 years. At it purchased the site for 25 million. The construction of the building cost 9 million and the fixtures and fitting cost 6 million. The construction of the supermarket was completed on 30th September 20x5 and it was brought into the use on 1st January X6. Sensco borrowed 40 million on 1st January X5 in order to finance the project. The loan carried interest at 10% per annum. It was repaid on 30th June X6. So basically, that is the case of specific borrowing, right? You borrowed the
Mm.
loan 40 million on 1st January X5 in order to finance this project. So that is specific borrowing. The interest rate was 10% per annum. It was repaid on 30th June X6. Okay. So you repaid the loan on 30th June X6. So if I consider the timeline, when did I took out the loan? 1st January, and the year end is 31st December. We are
Mhm.
considering this 31st December. And what is the interest cost? 40 million means 40,000. Let's do the working in triple zero at 10%. So 4,000 is the interest cost that relates to this period. And you purchase the site for 25 million. Okay, we have to calculate the cost. So first purchase price will be included here. Purchase price of 25 million. 25 million. Construction of the building cost 9 million and fixtures and fitting cost 6 million. So construction cost is a directly attributable cost, right? So we have to make it the part of the cost. 9 million, 9,000. Fixtures and fitting. Fixtures and fitting cost was how much? 6,000.
6 million.
6,000. Now the last thing is we have to include borrowing cost. Borrowing cost. Now, when did the construction of the supermarket was completed on 30th September 20x5? Construction was completed on 30th September. So how many months are there? Uh, 9 months, right? So it means 9 months of the borrowing cost you have to capitalize. So 4,000 times 9 by 12. 4,000. This is 3,000. So 3,000 of the borrowing cost you are going to capitalize. So this the total cost of this supermarket that you are going to show in your books would be 25,000 plus 9,000 plus 6,000 plus 3,000. That is 43,000. So this is the cost at which you will record the supermarket. When did you brought it into the on the use? On 1st January X6. So it means that you are going to depreciate that from the next year onwards. Okay. So in this way you calculate the cost of asset. and capitalize the borrowing cost.